Okay, so in this video, I'm going to introduce a few things about balance sheets. So let's talk about balance sheets. So the balance sheet is always for a point in time. So for example, the top of the balance sheet will typically say as of, so as of December 31st of some specific year, or as of, June 30th. So it's always as of one specific point in time. Now, and what it's showing in that one point in time is it's showing the assets, liabilities, and owner's equity. And if you remember back from basic accounting, assets equals liabilities plus owner's equity. So that's exactly what a balance sheet is showing, and that's why the balance sheet should balance, because assets should equal, actually they have to equal liabilities plus owner's equity. Now, within that, on the balance sheet, there are some things we can look at. So we could look at on the assets, whether we have current assets, which are assets we generally expect to be kind of convertible to cash within about a year, or long-term assets. So think things like property, plant, and equipment, long-term investments in some other company, things like that. So we could look at that split, the breakdown, what kind of assets. And even within current assets, we could look at, are those current assets cash, or is it inventories, is it accounts receivable, is it marketable securities? What kind of current assets? Because we might have different interpretations for those different kinds of assets depending upon which assets we've got. So those are some things we could look at on a balance sheet. What kind of assets? Are they current? Are they long-term? What kind of current assets? Or what kind of long-term assets? And then within liabilities, we could look at, again, what kind of liabilities? So are they current liabilities or long-term? So current liabilities are liabilities we expect to pay within the year. Long-term is generally going to be after that. So current liabilities, are we talking, is this all bonds that were issued? There were 30-year bonds that were issued 29 and a half years ago. So now they're in current liabilities because they're due in 6 months. Or are these current liabilities primarily accounts payable, which just an ordinary part of our normal business? What kind of current liability do we have here? And then also, within long-term liabilities, what sorts of long-term liabilities? Are they bonds? Are they some kind of pension liability? What kind of obligations are these? And when are they due? What kinds of interest rates do they have, if any? And then owner's equity. So under owner's equity, you could have preferred stock. And preferred stock is actually kind of like a weird hybrid between debt and common equity. And I'll probably address that more in a subsequent video, but it's a little bit of a weird hybrid. And that's why it actually is generally one of the first line items you see in owner's equity if there is preferred stock, because it's kind of like right on that edge between all the rest of the owner's equity but close to the liabilities. So that's kind of why it's there. And then common equity is going to have like the paid in capital and paid in capital in excess of par. So basically, this is the money the company received when they issued stock. So that's basically what's happening with that. But then we have retained earnings. And retained earnings comes from the net income that the company did not pay out as a dividend. So if the company made a net income and then they retained it, then that was money that was invested by the shareholders and so forth. Now, a little side note. That does not mean that whatever number you see in the retained earnings section is available for the company to spend. Far from it. The liabilities and owner's equity section is just tracking who, in effect, contributed the assets. So did the assets come from shareholders or from some form of lender? And so if we have a significant retained earnings line, that's just showing that shareholders have contributed that. If you want to figure out what the company has available to spend or use, go check the assets. Okay, so retained earnings is just showing shareholders contributed, this extra profit, basically. So there are some other things that we can look at as it relates to a balance sheet. So I could look at that level of liabilities relative to assets. So what percentage of my assets were financed with some kind of borrowed money, basically. And whether that's good or bad depends on how high the number is, and also what kind of industry it is, and what kind of business it is, and how stable the sales are, and so forth. I could also, as kind of noted, look at that composition of assets. Are they more current? Are they more long-term? Are they assets that appear to be productive? Are they not? Where are the assets coming from? How useful are they? Do we have too much inventory, for instance? Do we have too many accounts receivable? So, so looking at the composition of the assets and the nature of those assets. Same thing for liabilities. Is everything that's a liability, is it all accounts payable? Is it all coming due in like 30 days? That might be kind of panic inducing. Or is it all long-term debt that's coming due in 30 years? Well, maybe that's not so much panic inducing, unless all of the debt happens to be due at like the same 3-month period. In which case, well, that might be kind of concerning. So you might look at, kind of the timing of when the debt is coming due, and evaluate, is it spread out or is it all concentrated in a couple of years? It's going to be really problematic for the company, things like that. For the composition of the equity, do we have preferred stock? A lot of companies don't, but do we have that? And then also, have they been issuing a lot of shares, or is it mostly their equities coming from retained earnings? For the typical company that's been in business for a long time, a lot of the time they're getting extra equity through retained earnings, and they don't issue as many shares that often. And that's I'll probably discuss that in another video if we get to that. But that's a whole nother discussion. In any case, hopefully this kind of points you in the right direction of some of the kinds of things you could look at when evaluating just a balance sheet. Thank you so much for watching. Have a great day, and hopefully you'll see another video. Thanks again.